Hello, good morning. Welcome everybody to another episode of There's Insurance for That, your number one destination to learn something else in the insurance world. We are your hosts. My name is Nate Brown.
And I am Edwin Moreno, and today we will be talking about the difference between term life insurance and whole life insurance,
Yes.
which is it's an amazing topic because you see a lot of commercials about people being like, get life insurance, $2 a day, $1 a day, 30 cents a day. But so there's all these advertisements about how cheap life insurance can be, but people
Yeah.
don't know what they're purchasing,
Mm-mm.
right? Like they have no idea, like what is it exactly that they're getting. And so this is a very important topic, I think, for me as as a family man, as someone in the industry, as someone who sees these commercials, because I'm a consumer, right? I'm a
Yeah.
consumer. I see these things. I see these like billboards, these advertisements, and I'm concerned about that, right? So this is
Yeah.
like a very, very awesome opportunity for the viewers and the listeners to learn about what type of policy they have or what type of policy they might need, or just to learn the difference so that when they're presented with something, they they're at least a little educated, right? They have
Yeah.
some form of education. So what is the difference, Nate? Like, what's the
That's
difference?
that's big. And it's funny you bring up those commercials because nine times out of 10, when they're saying, get $1 million for 30 cents a day or something crazy, if you pay attention, it's somewhere small and to the left where it says, like, rates based on a 27-year-old female. Like, so they're
So you're
not
talking about fine
lying.
print. There's
The
fine print.
fine print, yeah, because then somebody's like 40, like, oh yeah, I can get $1 million of coverage for $1 a day. No, you will not, sir. No, you will not. Like, it's not gonna happen at that age. So, it's really big. And then for seniors, you'll hear, certain prices and things like that got this big, I'm gonna call them out, whatever. It is what it is. Colonial Penn is big for, they're saying like 9.99 coverage for 9.99,
I've
whole
seen
life
that.
coverage.
I've seen
And
that.
people like, yeah, no medical questions asked, no nothing, 9.99. And then they find out that you can get coverage for 9.99, like $1,000 per each 9.99. And that's like, whoa, like this is a lot for my social security budgeted income. And so it's a lot of things out there that you have to know about the fine print. So we're going to go into a little bit, have a teachable moment, and I'm going to call it term versus perm. Term is temporary and perm is short for permanent. So you're going to be seeing commercials for two different types of life insurance. They're both life insurance, which means, hey, when you pass away, your family's going to get a certain amount of money. However, term life is the one that is advertised the most. So it's temporary though. So it's like renting a life insurance policy. So most terms are going to be 10 years, 15 years, 20, 25, or 30. No more than 30. And so it's cool to have because term is always going to be a cheaper price. It's always going to be a cheaper price than a whole life product. So you're going to pay less, but so that'd be good. You can have like $1 million policy for maybe, depending on your age, $100 a month or $200 a month. You're like, cool. My children are millionaires when I pass away. That's great to have. However, if you're like 40 and you get this policy and then you live to see 71, guess what? That policy term is expired. And so then you're left without insurance. And to try to get another policy at the age of 71, good luck. It's going to probably be like $600 a month or $1,000 a month for $1 million worth. You might want to reduce it to like 100,000 or something like that. And then,
Wait a minute. 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 I just want to make sure I understand this well. I want to make sure the listeners and viewers understand this well. So you're telling me you're talking about term insurance right now,
yeah,
and you're telling me I'm renting this policy. So you're saying the price stays the same only for that amount of time.
Yeah, only for that term.
Only for that amount of time. So I outlive that time. You're telling me my insurance price could go up almost like 10, 20, 30, like that's like 100 times more almost.
Yeah, because it's based on your age now. And so it's like, hey, I'm 70. I'm not a spring chicken. So here's the difference. Like the insurance company says, yeah, cool. You're young. We got you. If you pass away the next 30 years, $1 million to your beneficiary. Great. But they're like, we'll prove you because the odds are, God forbid something happened. Yeah, we'll cough up that check. But odds are you're probably going to be healthy and live a lot longer past the 30 years. So in 30 years, you've paying us a premium. We've been investing it as the insurance company slash broker, and that's the deal. That's the contract. Hey, 30 years. After 30 years, you're uninsured. Then you need another policy. And so when you're trying to re-up that same dollar amount at 70, they're like, oh, you're definitely going to pass away within the next 30 years. We're definitely going to be issuing a check for $1 million, for example. It's going to cost you a little bit more. Like, yeah, you're going to put a little more skin in the game over the next 10 years because, and then it depends on your health too. Because they're like, dude, if you're 70 and you're healthy, cool. We may get you in at 600 for another. No, they actually won't even go past age 80 after 80. So you're probably going to get a 10-year term at that. So it might be 400. But if you have, got medical problems since then, you're like, oh man, I had cancer back when I was 65 and I got a heart problem now. I had a stent put in. And, then they're like, oh, dude, we're not going to be able to prove you like you're not in good shape. And so it's one of those things where like my recommendation for having a term policy, I have one, they're good to have, it's just extra money for your loved ones. But a real good reason to have one of those is like if you recently purchased a house. That one, they call it mortgage protection for short. If you got a 30-year term, you might for
Oh,
30-year
that makes
mortgage.
sense. Because you got
Yeah,
a 30-year mortgage, 30-year term. In case anything happens to me while I'm
yeah,
paying for this mortgage, my family's okay. They can pay
yeah.
off the house.
The house is paid off.
Y'all don't got to
So
worry about that.
yeah, if I got like a $300,000 house, I might want to get a $300,000 term life insurance policy. So, hey, if anything happens to me, wife and kids, pay off the house, whatever's left over, keep the rest for yourselves. That's a fantastic reason to have a term life policy, something like that. Or even if it's like maybe, hey, I know my kid just got 100,000 in debt for student loans. When I pass away, if they're still paying that, because they're set for you to pay them for life. When I pass away, here's 100 grand to go ahead and knock out that student loan, whatever's left, and keep the rest. So for temporary things that are still kind of long term, it's good to have a term life policy. um, However, it might cost you twice as much to have what's called a ROP term. So a ROP term is a return of premium. So that's something that you're going to pay a little bit more, but at least there's some icing on top of this cake. It's not like, hey, you paid this premium for 30 years. Guess what? We're going to give you back 80% of the premiums you paid. So over, 30 years, you've paid $100,000 worth of premiums. And now I'm 71 and they're like, cool, man, you're living, you had ROP term, here's a check for 80,000. Here's 80% of everything you paid us. We appreciate you. You can use that to be self-insured at this point, or you can invest it to maybe a permanent product or something like that, like a whole life, which I'll get into shortly. But ROP is going to usually cost you almost twice as much. So if you got like, let's say, for example, a $500,000 policy for $200 a month, but you want to have a return of premium option, then it may cost you like 350 for that policy per month.
But that's worth it though because I like what you're explaining right now. I mean, ROP, return of premium. That's what that
Yeah,
means. So they're promising you to return some of that money that you've been paying for
yeah,
that policy, right?
yeah,
I'm sure there's like maintenance fees. I mean, it's a business, right? So
yeah,
you're paying for this policy and like, they gotta freaking pay the employee that's like doing the underwriting. And So it makes sense that they don't give you 100% of it back, but
Yeah.
they give you a pretty high percentage because you paid for it. They're like, you paid extra, so we're gonna give you some money back.
Yeah.
Since like you outlived, but that would suck to outlive a policy and then be like,
And get
all right,
nothing.
well, I guess at least I'm here, I guess. Like,
Thanks for living. Appreciate you. Goodbye. And believe it or not, that's the way they used to be. Before they started doing ROP or living benefits, which I'll touch on soon, it used to be, hey, thank you for surviving. Contract's over. Appreciate you. So
but people
national
probably got
average,
wisen up. People were like, wait a
national,
minute.
here's why I would probably recommend a whole life more than term life. Here's the reason why. The national average of term life policies that actually pays out money to the beneficiaries because someone passed during that term is 2%. So out of
Okay, hold on, folks.
100,
Hold on, folks. We gotta hold on. Let's rewind. Let's rewind real quick. Could you repeat that one more time, please?
yeah. So out of 100 people who have a term life policy, only 2% actually pass away during that term and their family actually get the money from that policy. That's the national average.
So only two out of 100 people actually benefit from the benefits, like the life insurance benefits
Yeah,
that are provided, that
yeah,
have a term. These are people that purchase term policies.
term policies. Yes.
All right. All right.
Yes.
Well, I I know a lot about term now. I want, so what's the difference? Like you kind of said a little bit like that's why you recommend to get whole life or permanent
Yeah.
life. But so what's so
So
I mean, I'm kind of getting the difference just off the name alone, but could you like break it down a little bit more? Because I'm sure
yeah,
there's
so
more
a
than just that.
permanent product, I mean, they have like IULs and different things, but all they are different variations of a whole life plan, which means, okay, this isn't a term. We are going to insure you for your whole life up to age 121, as long as you're alive and as long as the premiums are paid. And so that in this one, the insurance company is looking like this person has made a contract to pay this premium. They are definitely going to croak while they're in this contract. So we are definitely going to pay whatever this is. So because they're more like certain that they're going to be paying out something, they're going to be like, all right, we won't offer you 500,000 at 350, but we'll offer you 250,000 at 300 or something like that. Like it's you're going to get less in the contract, so the coverage costs a little bit more, but it's insured your whole life. And here's some of the things that they sweeten the deal. Like within a whole life contract, there's like a portion of your premium that goes into something called cash value. So it's like a small savings account that's going on. Let's say 20% or so, for example, of your premium is going to go into a sub account that's going to be earning interest every single year that you're paying this premium. And so because of it's you can actually grow this money there and take it out in the form of a loan or withdrawal. If it's in the form of a withdrawal, of course you have to put it on taxes, but most people take it out as an insurance loan so that way they never have to pay taxes on it. So that's something that's like, hey, I'm paying more, but have access to some money, as life may come up with a specific need real quick, or at least have an emergency fund inside of this contract. Another thing that pretty much almost at this point, almost 100% of all whole life carriers have is something called living benefits. So living benefits, they're like, okay, we notice over the years that when people start to get older, they start to have health complications, and we don't want them to stop paying their premiums just because now they have to pay this health situation or things of that nature. So they have something called living benefits. So that means if you have any a critical illness, a chronic illness, or even a terminal illness, you can advance up to 80% of that death benefit. So for example, if you had that $500,000 policy and you just found out you had cancer, you say, hey, I'm gonna be in chemo and radiation for 6 months. I need another 6 months to recuperate. my job pays me 80,000 a year. Here's a doctor's note. Here's insurance company. See, the doctor said I got cancer. I'm about to be out of it for a while. I need 80,000 from off my death benefit now. And they'll go ahead and send the checks. You can go ahead and take care of your mortgage and keep the lights on and not have to worry about any financial disparity while you're trying to fight for your life, you know?
Right.
So that's
So
good to
do
have.
these living, I just want to make sure I understand right. Do these living benefits, are they only included in whole life products?
You know what? Up until about maybe 3 or 4 years ago, they were. And most of the term carriers still don't offer them. So, but
For
there
sure.
have been a
But there are
few.
some, so maybe those are the things that they might have in common, but the biggest difference here though is you're guaranteed like it's like that price isn't going to change on you with this whole
Mm,
life. Like
nope, it's fixed forever.
it stays forever no matter what. So it's like I could add that living benefit to my policy. It's kind of like that double protection,
You
right?
know, it's
Because it's like,
crazy. They got them now. They're automatically included in the premium. Yeah,
wow,
they're already set in the premium companies. Most of the companies, Foresters, Mutual of Omaha, Mutual Trust Life, they
man,
already
y'all,
have it in
listen.
there.
Hey, y'all listen, if you have a family member that's going through something or you know someone who's going through something, see if they have a life insurance policy, right? Because, they might have a permanent life insurance policy. They didn't realize that they have living benefits on there, and that's something maybe that they could use. So, I mean, that's a really great point. Can you break down a little bit more? You were talking about whole life and you mentioned like IUL. You were talking about like, these like acronyms. I don't really know what they mean. What is
Okay.
that? Like, what are those other types of whole life? Like, what does that mean? Like, what's
I
the
mean,
difference?
they have your basic whole life, which is just a permanent life insurance plan. When you're younger, you can get, you're healthier, so you can get bigger numbers for a smaller amount, which is it's the best. I don't care if you're a 2-year-old baby, get a whole life policy on them while they're two. That price will be set for a 2-year-old their whole life. So you don't want to wait till later on. A lot of people wait till like 45, 50 and up to get a policy and then financially find out they can only afford maybe 50 grand, maybe 100 grand. But you can, at 2 years old, dude, you can get half a million for so much cheaper. So, but an IUL, like, let me go back. Whole life protects your whole life. Then there's other types of variations of whole life. There's one called a participating whole life or infinite banking policies. These have a certain participation in the market, kind of, so you kind of have some index funds that are your money is growing with. So that's kind of cool. So those are different and they're better in a way because let's say I have a whole life policy of just $100,000, for example, just basic whole life living benefits, cool, it's $80. If I have a participating whole life, that death benefit that my family's going to get is 100,000, but because it's participating in index funds in the market, that number is going to grow. So it may be in 10 years, it might be 167,000. In 20 years, it might be 254,000. Same premium cost, doesn't go up. So, I mean, if I live 40, 50, dude, that policy could fool around and be 400,000 bucks, so that's really cool. And then again, if I need 20% of that for, that's in my cash value, hey, I need 20 grand for a new car. Boom. I requested out of my life insurance policy and just get it sent over. Like I had a client who had a policy for a long, he's probably like 67, and he was like, "Hey man, I know I got some money in my policy. I get my statements, but do I have to be critical or chronically ill to just get some?" I said, "No, that's called the living benefits. But if you have cash value, dude, that's yours. Like use it." And he said, "Dude, I just want to get some yard work done. It's gonna run me like 10 grand." And he just didn't know what to do. So we called his carrier. He had a little over 15,000 in cash value. He was like, "Can I get like 9,000 or so out? Matter of fact, let's make it even 10." Dude, the money was direct deposited in his account in like 2 or 3 business days. He was
Wow.
able to make that happen tax free. So, I mean, that's one of the benefits of having a whole life policy. Most terms are not going to have cash value growth in them. They're not. They do have a few carriers that also offer living benefits, as a term, but it's kind of limited. It's not as vast as your whole life products. And then a IUL, just to touch on that, that is also a permanent product, but that is completely, you can structure it to be what's called level, which operates like a regular whole life plan, or you can have a combination of some growth and then maybe level out later on. But that's kind of like a hybrid. It's like kind of the best of both worlds. So you have that, you can set it to, every year you could change the indexes on there. Like, hey, S&P is performing better. I want 50% of my cash value on S&P and maybe the other 50% on a BlackRock index. So you have a lot of variables that you can kind of mess with on an annual basis to grow your money. So a lot of people utilize a IUL to get a tax-free retirement. Like for example, let's say it 100,000 of coverage may cost $200 a month, but someone may say, I want to put $500 a month and 300 I want going straight to my cash value. And then when I get 65, I want to then take tax-free supplemental income for the rest of my life. Like, hey, I have enough in there. I've overfunded this thing and it's been growing in the market safely. Uh, because another benefit of an IUL, Index Universal Life, I'm sorry, Index Universal Life. It's
I was about to ask you. It's
it's
cool.
it's,
I
it's
got you. I was
participating
about to
in
ask you.
index funds throughout the whole time, and it's universal because you can kind of shift and move your premium payment however you like throughout the course of your policy. So
Right.
a
Because if
term
it's
is pretty much
earning, if it's earning enough money, I could just use that money to pay off the policy if I wanted to.
you earn dividends on it and everything, and so it's really cool. Um, The term is level for those years that it's set for. The whole life is level, can't change it. It's pretty much set in stone. The IUL, it's like, hey, I was started off 200 a month. I just got a raise at my job. I want to up this to $400 a month. Same policy. Everything. I just want to put more in there, and I want to grow. And over time, you might have like, multiple six figures in there by retirement because of the growth and say, hey, I wanted to pay me an additional, I got my social security or whatever
But
it
let's
is.
not lose. I just want to I apologize. I just want to make sure this is a life insurance policy, y'all.
Yeah.
Like this is also, 'cause I also don't want to lose track of some people might be like, well, I got money in the market, I got money in investments, I don't need that. But it's like, well, no, 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 no. This is a way for you to have both in one, basically. Whereas
Yeah.
if you got all that, where's your life? How's your life insurance set up?
Yeah.
And you could actually set up a policy that's earning, while it's protecting you at the same time, which is a
Exactly.
great way to have your money work for you, right? That's
There's
cool.
another sweet
I
deal.
just wanted to highlight that.
Yeah, I appreciate it. There's one more good sweet deal to the IUL. That's almost like a pod in itself on educating that, but if you overfund it enough, you can do it with a participating whole life as well. Let's say you overfund it, you're paying twice as much. You want to really grow cash. And like I said, a lot of my clients' policies up to age 65. And we set up at age 65, you don't have to pay any more premiums. You've put so much in that the compounding is going to take care of itself for the rest of your life. And if you would like to, yeah, you could take another $2,000 or $3,000 tax free every single month for the rest of your life and supplement your retirement. So a lot of people use it as a tax free supplemental income over time. They say, I'm going to overfund it for 20 years and then I'm going to sit back and collect for the rest of
Right,
my life. And so
right,
that's the difference between like a variation of a whole life versus a term. That option does not exist with a term. It does not exist. So, but a term you're really gambling like, if I live these next 20, 30 years, family's good, but if I outlive it, crap. You know what
right.
I mean? And
Well,
so,
what I like is that there's a way with the return of premium, there's a way to alleviate that.
yeah,
And I also want to give, because some people can't it's like the
that part.
affordability. You know what I
Yeah.
mean? Just affordability, where people are in their life right now. I love the thought process of hey, look, you could build wealth, there's possibilities, but there's also people that don't, they're not even there right now, right?
Yeah.
It's I'm trying to survive type of stuff, right? I'm trying to
Yeah.
I could understand, but you can start somewhere. And
Somewhere.
and so I love, we're I would say we're at time. you know,
Okay.
I just want to like share kind of like I love how there's could be an option for everyone. And
Yeah.
you could evolve from those options because you could start with that 20-year term return of premium, get that money back. Once you get that money, yo, Nate, I want to get one of those IULs. Like I got this extra money. I still get paid, I still get money consistently, but now I want something more permanent and I
Yeah.
have a decent amount of cash that I could just put into it right off the bat so like it doesn't hurt me that bad, right? Like to put this
Yeah.
money into that. And so I think that I like the thought process of like evolution with it. And that's kind of like what I'm getting
Mhm.
from like
Yeah.
what you're saying is that sometimes if you don't have the means, it's cool. Learn so you could evolve and apply it as you evolve.
Yeah.
And I think that's what stood out to me the most. Another thing that stood out to me the most is how many options there are in a whole life product. Like I didn't know whole life could be shifted into so many different things and you could use it so many different ways. So I love just like how like I love all that. Like that's really dope to know like, oh yo, there's so many different vehicles that could be used. Um,
Yeah.
and so yeah,
I,
man,
I
I appreciate, you know, and if you were to say like the main, like, man, if it, like just to break it down, the easiest way, like someone who's listening, someone who's watching this, like what's like, what would you want them to like go home with the most about these two different products? Like the difference between these two products, like what would you say is the most important thing about these two that you want people to like always remember?
I will always say something is better than nothing. Like some form of protection is better than none. Like I had a client once who, after doing her budget, God bless her, she wanted something for her one son, and at the moment, she literally is like, "I'll take anything." Like we had a $12 policy. It's like $12 a month for a few $1,000s of coverage, and it was like, I don't care if something happens to me, he can that's at least half my cremation or something. I don't know. She was just like, I just need something, and then, when my financial situation improves, I can get more. And which is cool because you can always add on. You know, we people that enter, we have several different policies. We have IULs, whole life end terms on ourselves. We have various different things going on. So for simple reasons like, hey, if I do pass in the next 30 years, I'd rather my family have a whole lot more because that term is going to cash in versus just using one product. So I like that you can stack them up and compound them and use them for different things. So, but I would say always start with something, whatever you can afford, get something that's affordable that meets your need and your budget, and you can always make edits and changes or add on or, different things later on.
Man, bro, I love that. I didn't even think about that. Like you could have more than one policy. And it's
Yeah,
like that's how like yeah, you could keep building off that. So hey, yo, that's awesome. You wanna sign us off?
for sure. I hope y'all learned something. Thank you so much for watching. Stay tuned for next week for another episode of There's Insurance for That. God bless you all. Have a good one. Peace.
Peace, love.